What's up? This is Ryan with Planet Cheapskate. In this video, we will discuss how to have no closing costs when buying a home. So I'm going to break down everything you need to know to get the cheapest mortgage loan costs. Now be sure to also stick around to the very end of this video for 4 loan hacks that will reduce your stress and anxiety when it comes to buying your home. But first, I'd just like to take a very brief moment to personally invite you to subscribe and join our community. I do a home loan rate update every Friday going into the weekend, along with new videos on Thursday helping you manage through the world of credit, real estate, and home loans. And also, when you do subscribe, be sure to hit that little bell and it will alert you whenever I release fresh content. Now, with all that out of the way, let's dive right in. So it's important to understand when we are talking about closing costs, what we're actually talking about is funds to close or cash to close. Now, they're made up of 2 parts. The first part being the down payment and the second part being your actual closing costs. These 2 combined are often referred to as your funds to close or your cash to close. Now, it's important to understand that while yes, both costs can be reduced to 0, we must approach them each differently. So in an effort to educate the best, I will first summarize what the down payment is, and then go into the closing costs and what they are made up of, and then once we fully understand these 2 separate expenses, we'll then move into the ways we can reduce both of them to 0. So to begin, we'll discuss the down payment, and the thing to remember with a down payment is it actually isn't even a fee or cost at all. Your down payment goes 100% to your equity or principal balance of your home. See, when you buy a home, there's a difference between the price you pay and the value of the home. For instance, you may get under contract on a home for $200,000, but when the appraisal comes back, the home is worth $210,000. This would mean that you're walking into the home with $10,000 in equity. It's sort of like having $10,000 in your own personal bank account. That's your home. So when you put a down payment, the entirety of that amount goes towards your equity or principal balance. So if you're required to put 3.5% down on a $200,000 home, it means you now have $7,000 added to your home's equity. I hope this makes sense. If you have any questions, please leave a comment below and I'll do my best to clarify further. Now, moving on to your closing cost portion of your funds to close, these are made up of several categories. You have the loan costs such as origination fee, possibly an underwriting fee or processing fee, and anything associated with the cost from the lender to provide your loan. Next, you have various taxes depending on your area. Then you'll have title or closing attorney fees. You'll also be required to pay your first year's worth of homeowner's insurance and your first month's prorated interest on the loan. These are normally called your prepaids. You'll also have an escrow buffer amount for your home insurance and property taxes. This amount is usually figured by the lender in title based on the area that you're in and when items are collected. Your escrow account is the account that holds your homeowner's insurance and property tax portion of your mortgage payment until those items are due. And this is so you only have to worry about 1 monthly payment. They usually pad these accounts by a few months for if your insurance or taxes go up in the middle of the year, you're less likely to have to change your mortgage payment. Now that we've broken down both sides of the funds to close, or sometimes called cash to close, we can now move on to the tactics and strategies to eliminate them and get you to the closing table with $0 out of pocket. Now, it's important to know beforehand that there is one expense that's very, very difficult to get eliminated, and that's because it's the only thing your lender will require you to pay before closing, and that's your appraisal. Now, with that said, there are 2 methods to handle that expense. One, you can have a family member write you a check as a gift to cover the cost of the appraisal, and then do a gift letter. Another way to offset this expense would be to factor it into your seller or lender credit, and by doing so, it should be reimbursed back to you at closing. The first expense we will tackle is your down payment. So this one's a little tricky because rules in lending prevent you from using any sort of borrowed funds or loan credits to offset your down payment amount. With that said, there are still a few different methods you can go about eliminating your down payment. I'd say the easiest by far would be the use of, if applicable, either the VA or USDA loan, which both do not require a down payment. If you want to check if these loans can apply to your situation, then check out the playlist at the end of this video where I break down each major loan product. The second easiest would be to get gift funds from a family member to cover your down payment. If you go this route, just make sure to coordinate with your loan processor as things need to be done a certain way to avoid problems with your gift. The third option for eliminating your down payment involves using down payment assistance program, also known as DPAs, or using a down payment grant. from a private agency or government. Now, I used to be a huge advocate against DPAs or grants because most of them do carry a ton of negatives, such as locking you into an extremely high rate for several years, and only way to get out of it would be to pay a fee. Lately, however, there have been a lot of good products hit the market that are actually decent, such as UMortgage's Empowered product or the Chenoa grant. These two, while not being 100% without negatives, are actually pretty good benefits for cash-strapped individuals. So those are the three options for eliminating your down payment. Now understand, by eliminating your down payment, it will make your monthly payment higher. There's just no way around that, as you are borrowing more money. The second expense that makes up your funds or cash to close is your closing costs, and these are a little bit easier to get covered. As is anything, there are a few negatives to be aware of when using these options. The first option you have is the use of gift funds. Much like the down payment, gift funds from a family member can be used to cover your closing costs. This is probably the cheapest option out of all of them. Another option to cover your closing costs is to ask for the property seller to provide you with what's called seller credits or seller concessions to offset fully your closing costs. Now, you will need to coordinate with your loan officer to make sure these costs can be fully offset, as there are limits percentage-wise for how much seller credit you can request. The last option to eliminate your closing costs, which can be used independently or in combination with the seller credits, are lender credits. Now, lender credits usually involve taking a little bit higher of a rate than what you would normally qualify for in exchange for the lender to actually provide you with funds to offset your closing costs. But also, much like the seller credit, there are limits to how high the lender can actually bump your rate up. It's best to use these two credits in unison with each other if possible, rather than one over the other. So as promised, 4 amazing loan hacks that will help you avoid stress and keep your sanity while going through your loan process. Especially if you're attempting to do a zero funds to close purchase, you'll want to use these hacks to speed up the process. In my experience, the longer the file sits in the underwriter's desk, the worse it is for you as a borrower. These loan hacks will have your loan flying off the underwriter's desks. So the first hack is to go through your last 2 months' bank statements, and if you see any deposits or withdrawals besides your work income that are over 1% of your loan amount, write a little description on a post-it note or next to the item on the statement. This will help your processor explain what's going on. This is often something that slows the process down quite a bit. The next hack would be to make absolute sure you are completing your pay correctly. Make sure if you're hourly, you're reporting the correct amount per hour and the correct hours per week. If you're salary, just make sure you get the annual amount correct. Only include overtime or bonuses if they have been consistent for 2+ years. I'd say one of the biggest reasons loans are denied after the conditional approval is based on someone overstating their income. The third hack is just to make sure that before and during the loan process, you are not running up huge balances on your credit cards or signing up for any new credit. This can really screw up your loan process big time. And finally, when it comes to gifts from family to offset your down payment or closing costs, never try to figure them out yourself. Always ask for assistance from your loan processor or loan officer. The lenders are very, very picky with how they want money transfers to take place. So there you have it, everything you need to know about how to have no closing costs when buying a home, along with 4 loan hacks that will help you avoid the typical stress and anxiety when buying a home. Please leave a comment below if I missed anything or you have any questions. I'd love to hear from you. And listen, if you gained value or knowledge from this video, do me a huge favor and smash that like button so more people just like you can see this info. And if you liked this video, I'd like to invite you to watch one of my other videos. Over here, as I discussed earlier, I break down and hack every major loan product. And over here, YouTube has determined that you may enjoy this video. Thank you for tuning in. Until next time, best of luck.